Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets, coming hot off the heels of a jaunt out to Dubai for the Forex Expo. I'm back in Old Blighty, and I'm going to provide you guys with a rundown for the week ahead. It's a massive one. We've got inflation out of the US. Of course, there's question marks about the US shutdown and whether that will enable the release of this data. Well, it appears the Bureau of Labor Statistics are willing to make the efforts to get a couple of people in-house to be able to put this report together. Alongside that, we've got the jobs report out of the UK. And of course, this is really the beginning of the third quarter earnings season out of the US with big banks in focus. So on that front, I'm going to provide you with a little rundown of what to look out for when it comes to JP Morgan Chase. So first and foremost, as ever, we're going to take a look at the overview, according to Trading Economics, of what the big ticket items are on the economic calendar. Now, we kick off on Monday with Chinese data, inflation data coming out. Inflation data is coming out later in the week. We've got trade data on Monday, inflation data on Wednesday from China. So there will be a focus on China over the course of the week. Tuesday, we've got the business confidence survey out of Australia, the RBA minutes. Then we've got the jobs report out of the UK. We've got an appearance from Powell on Tuesday as well. Then running into Wednesday, you can see here there's no times associated with any of this US data, the likes of inflation, the likes of CPI, PPI, some housing data at the back end of the week. So there's obviously question marks about how much of this actually will be released. But we have been hearing that essentially the BLS are going to try and pull some people back into the office to try and put together the data for the CPI numbers, at least because that data is required when it comes to the quarterly benchmarking of wages within the federal government. So it's needed for another reason, but we're thankful because, of course, we like seeing the data. We like trying to gauge exactly what the direction of travel is for the economy, and of course, trying to gauge exactly what that means in terms of monetary policy and therefore the likes of US markets, the US dollar, the likes of gold, etc. Right. So it looks like we will see CPI coming out this time around. Now, alongside that, we have got earnings kicking off this week. And so this is the rundown in terms of the earnings picture. So you can see here heading things up in terms of, this is in order of market capitalization. You can see JP Morgan Chase. Then we've got Johnson & Johnson, Bank of America, Wells Fargo, Morgan Stanley, Goldman Sachs. So really, there's a massive focus on finance, right? Because we've got Amex as well, Citigroup, BlackRock. So yes, you've got Johnson & Johnson, but by and large, this is really heavily focused on that financial sector, as appears to be the case nowadays. That's how we kick off with earnings season. And so I wanted to look at JP Morgan Chase. We'll do it at the back end of this. We'll start off with things on the sort of economic front. So this is a closer look in terms of what we expect when it comes to the US data, kicking off with a focus on Tuesday around the Federal Reserve, Bowman, Powell, Waller, all making appearances. Wednesday is that inflation report where we've got core inflation expected to come in at 0.3 for the month, headline 0.4 for the month. That's the important part of it, right? It's not necessarily the year on year. I know the year on year is the sort of big ticket item that really sort of leads us to believe whether the Federal Reserve are going to be able to act or not, whether it's above target, below target, etc. Of course, that's important. But over the near term, we need to know whether we're seeing inflation sort of rearing its head or whether it's on track and at sort of relatively low levels. And we have been seeing it rise recently. Another 0.4, that would be concerning if we did see that coming in. And I'll show you on the chart in a second. So alongside that, Philly Fed on Thursday, we've got the PPI, retail sales, industrial production, housing starts. Not all of them will be released, depending on whether an agreement's made. Certainly, interestingly enough, we've got this initial jobless claims figure. I cut it out because essentially I was a bit squeezed for space to be able to put onto this slide. But the initial jobless claims figure, there was an expectation that we could see 3 weeks worth of it if we see it released. And that means that by and large, once we do see that agreement reached in terms of ending the shutdown, then we could see it all just dumped on us, basically everything that we've missed. Crucially, I think, we're 10 days into it as I record this video. Markets currently pricing, the betting market's currently pricing 24 days of shutdown. Of course, we don't necessarily know, but certainly people are sort of hunkering down, and that the expectation isn't right now that we're going to see a resolution reached immediately. Like I said, 0.4 would be troublesome where it comes to CPI. And you can see that here, right? So the trajectory in terms of monthly inflation to me is really important because yes, the year-on-year figure tells us everything that's happened over the past 12 months, but we need to know whether the tariff measures are inciting and kicking off a phase of resurgent inflation. You can see over recent months, gradually we're going higher and higher, in particular when it comes to the blue sections, which is the CPI and the core CPI. The core PCE by and large sort of flatlining between the two, 0.2 and 0.3. So the Fed will be encouraged by that. But certainly when it comes to the CPI reports, it points towards inflation starting to pick up in a meaningful manner once again. And that's not a good thing, really. And so if we do see more of the same when it comes to upside in terms of inflation, then it potentially sort of reins in some of those expectations around what the Federal Reserve are going to be able to do, in particular next year, because this year market's very confident that we're going to see 2 rate cuts from the remaining 2 meetings. Of course, one is at the back end of this month, and then one comes in December. Now, where we want to reflect this, for me, I wanted to look at gold, because gold is, and coming off the back of this trip to Dubai, I made a number of appearances to different TV stations and talking to the likes of Shark, the likes of CNBC Arabia, the likes of Sky. Everyone just wants to talk about gold, right? And this is the case for our clients as well. Our clients, everyone is keen to know about gold because, of course, we hit the 4,000 mark. But this isn't something new. This is a trend that's been running for such a long time. It's been a great trade. And so we're actually now starting to see a bit of a pullback coming into play. And so the fact of the matter is that this isn't just around central bank policy over in the US, but that's something that can play into it. Certainly. Interestingly enough, like I said, this isn't just a central bank policy issue, but I'd be interested to see exactly how things are playing out in terms of the relationship to the 2-year, which is sort of quite reflective of exactly where the sort of direction of travel is in terms of expectations for the Federal Reserve's rates. You can see here sort of downward trajectory in terms of yields, upward trajectory in terms of the US, in terms of gold prices. What would be interesting here if we sort of grab that 2 years, if we invert it and see exactly how that looks. So you've got that sort of inverted relationship between the two there. You can see at the moment that sort of stuttering a bit. Nonetheless, the way that we're sort of playing this in terms of rates is that if we see an additional expectation around the Federal Reserve to be easing, i.e. markets had been pricing 2 to 3 rate cuts for next year, but the Federal Reserve laid out just 1 rate cut for 2026 in the dot plot. That market expectation sort of points towards a pricing of looser monetary policy that isn't a given. And that was one of the sort of headwinds that I have been alluding to as we come towards the back end of the year. But certainly as we move through the current months, if we see data that points towards the Fed needing to be cautious, then I think that would weigh on the likes of gold and the like. And so what we're seeing at the moment is gold starting to pull back a bit. It's crucially coming back towards this trendline support, though. So, I certainly am not one to stand in the way of a trend like this. I'm not saying, I'd want to short it here. I still remain bullish for gold. One of the reasons why I'm very bullish for gold is that one of the drivers behind it is that the lack and loss of confidence around the US in particular, and the rise in terms of debt. And that just isn't going anywhere, quite frankly. Whether it comes to Europe, when it comes to the US. So that means people are looking towards assets that can't be inflated away, that can't just print new gold. You can dig it out the ground, but I wouldn't necessarily say that supply is fully reflective of demand, and demand's been driven up in a heavy manner. So irrespective, what we're seeing at the moment is this pullback coming into play here. I keep a close eye out on the potential for a rebound from trendline support. But like I said, certainly if we're coming into this and we see the inflation data coming out in a, let's see if it's going to be somewhere in the middle. I think it'll be like 50%. If, yeah, so we're around about a 50% retracement at the moment. We could possibly come into I wouldn't say the fibs are really that useful here, but yeah, so we're coming into a phase where there's some caution. Certainly, we've seen a very strong move towards the upside. This move towards the downside that we're seeing at the moment, if anything, is just a case of taking some of the heat out of the market, which I think is needed, quite frankly. If we did see inflation coming in towards the upside, if you see markets pricing towards less rate cuts, less conviction around rate cuts in the US, I think that would weigh on gold over the near term. So certainly when we're looking for how to play this coming inflation data, I would say that gold is a really interesting one. It's run very heavily towards the upside. You're always going to see pullbacks within trends. That's what we're seeing at the moment. Quite whether that is going to be something that we see as a more protracted pullback or not, that remains to be seen. And certainly if we're looking at this trend, for me, I would need to see a break all the way back below 38.19 for me to say that I'm not necessarily that bullish anymore. But for me, I don't think it's going to happen. I think short term, yes, we could see a pullback. But, time will tell. And I think the inflation data will be key. And also the trajectory of the US dollar will be key, because we have actually seen the dollar starting to rise at the moment. And now we're starting to see the price of gold coming off as well. In terms of the next area we wanted to talk about, it is the UK. And certainly the UK at the moment has come into the limelight where people are very fearful around the direction of travel for the UK. I mean, look, we don't necessarily have a sort of very high unemployment rate at the moment. Growth prospects aren't great. We've got a budget coming up, which is likely to see increased taxes. There's all these stories about people leaving to go to, funnily enough, to Dubai. All the rich people are leaving, and we're left here to pay higher taxes. That's the theme. So the confidence certainly isn't that high at the moment, but inflation is high. So it's not like the Bank of England can really step in a meaningful manner and drive down rates for the time being, unless they see the economy really take a meaningful turn. And so we can see here in terms of the jobs report on Wednesday and then some of the data on Thursday, we get additional information around the direction of travel for the UK economy. 4.7 expected, flat on the unemployment rate. A decline in terms of average earnings would be welcome, quite frankly, if that means that we see lower inflation, which is a thorn in the side of the Bank of England. Claimant count expected to be in positive territory, though. That would be the first time that we see consecutive rises or gains in terms of the claimant count in a year. Then if you're looking at the month-on-month GDP, 0.1, okay, that's fine. Not blowing the doors off exactly. Industrial production back in positive territory, blah, blah, blah. You can see all the numbers here, right? But I think the jobs report is going to be interesting. The GDP number might take a bit of the headlines as well. But the question mark is, do we see a sort of deterioration, a meaningful deterioration that might signal something to the markets? You can see here in terms of the jobs market, we now saw that rise in terms of the claimant count last time around with that latest positive orange bar. There's an expectation we see another positive claimant count rise. So that's not good news. The unemployment rate has been rising, so markets are expecting that to flatline, but the trajectory is towards the upside. So if we did see an increase in terms of that, then you'd say that could be the kind of thing that could maybe garner a bit of attention within markets. Notably in terms of borrowing costs, or i.e. Some of the yields on UK treasuries or gilt, you can see here that the 30-year has been moving towards the upside. That is similar to the kind of thing we've seen over the US, where you see upside in terms of long-term yields, but they're sort of shorter term, very much moving towards a downside where you had increased expectation of easing, and then that's sort of flatline now. So the expectation of the central bank to be able to take any actions, not really there at the moment, and therefore this jobs report can provide the basis for that. So certainly at the moment, there's a little bit of caution and a lack of confidence around the idea that really that we're going to see lower rates coming into play anytime soon, or certainly in a meaningful manner. In terms of what we're seeing from a sort of market perspective, Euro sterling is one that I've been following a lot and talking to you guys a lot about over the course of this year. We're talking about these big pullbacks and stuff. Where we are at the moment, we're not necessarily seeing that big pullback. We sort of topped out, but then just started creating this sort of gradual uptrend within that. And now we've pulled back into this confluence of the ascending trend line, the 76.4 fib. We put in that doji candle, we put in the bullish engulfing, and now we're on our way. In terms of the 4-hour chart, we can see that we haven't yet broken out through your first swing high, which would be a move through 0.873 essentially. We've run towards that. We've broken up through any sort of potential Fibonacci level. Now pulling back a little bit. But for me, with that trend line support coming into play, the Fibonacci respected absolutely perfectly. I do think that this is likely to be the bottom. It means a likely push up through the 0.87515 resistance level that we have here, sort of instigated back on the 25th of September. And so I'm expecting to see more upside coming into play as we move forward. Look, ultimately, the ECB's pretty much done its thing. The Bank of England's still got plenty of ammunition in the tank. It's a case of either the inflation data coming in towards the downside or the economic data starting to roll over. And this week gives us plenty of opportunities to see that second part of the dynamic potentially coming into play. So if we see weak economic data, I'd expect to see another pop here for the likes of euro sterling. We need to see for this bullish trend that's in play at the moment, we need to see a breakthrough 863 to negate that bullish trend that is currently playing out. Now, finally, like I said, we're going to be looking into things from a corporate perspective, and that, of course, is all about the big banks. This is just quickly, this is UK rates. I've missed this out. So where are we going to see the next rate cut? Well, markets aren't super convinced beyond one rate cut, right? So you might potentially, for a coin toss, see a single rate cut beyond that, the back end of next year. Yeah, it's not exactly inspiring, but maybe the data will change things, right? So like I said, JP Morgan Chase reporting for the week ahead. These numbers are not super clear to see. Let me get rid of my big old head. That might do you a favor. Here we go. So the key thing here is that basically we've got the expectation that on a sort of year-on-year basis, many of these figures are expected to gain ground. By and large, time and time again, JP Morgan managed to outperform expectations. So what you might look at the figure and say, okay, if you look at a year-on-year basis, you've got 485 expected on the earnings per share. In terms of last year, it's 437. Say, okay, it's decent growth, but then there's a good chance that we perform beyond that as well. What's going to be interesting, of course, is we still have relatively elevated interest rates over in the US. So that's good news when it comes to margins. But then we have question marks around economic confidence levels, what's happening in terms of the US economy with Donald Trump's tariffs coming into play, and how businesses are taking on loans or not, holding off perhaps. So you've got that side of it that we'll be looking out for. You've got any trading activity for sort of investment banks where the equity markets are at record highs. So that should be beneficial for them. So a number of different tailwinds and potential headwinds to be looking out for within this earnings report. But time and time again, this is a bank that outperforms. And certainly from a sort of charting perspective, I think it's yet another really interesting chart to be looking out for. And when we look at exactly at that, here is the JP Morgan chart on a daily perspective. So let's just get rid of the Bollinger Band and simplify this a little bit first and foremost. We can see here, from a daily perspective, you can see here 1, 2, 3, 4, and we're coming in for a fifth touch of trendline support. So this report is coming in at an absolutely perfect time, an advantageous time. Now, what I like to look at as well is how it's responded to previous earnings reports. So you can see here, this is an earnings report, didn't see a huge amount of movement, but ultimately this zone represented a low and we pushed upwards from there. We saw an earnings report here where we ran up into it, faded a little bit, but then pushed onwards from here. You can see this one marked a very strong buying opportunity that we ran higher for the next, say, month. Beyond that, you can see here, we jumped higher, consolidated, jumped higher, consolidated, jumped higher. So again, that was a great buying opportunity. Then this moment, we saw a strong initial reaction, consolidation. We ultimately retraced, and then we moved upwards from here. But ultimately, the share price generally, whether we see a little bit of a pullback, whether we see a bit of a consolidation, generally seems to be resolving towards the upside. Now, where we are at the moment, you know, as long as we remain in this uptrend that's currently playing out, which would mean that we need to stay above this near-term swing low of 291, that to me points towards this like this pullback as likely representing an area that could be an opportunity, much like many of the other opportunities in the past. Now, crucially, if we put the Bollinger Band on, you can see here that the lower Bollinger Band, by and large, we get close to that, but then ultimately we see the bulls coming back into play. Well, that's exactly where we are at the moment. So we've got the confluence of the lower Bollinger Band alongside the ascending trend line. To me, it signals the possibility that the bulls are going to be back in play before long. And like I said, 291 is the line in the sand. If we break below that level, in my mind, then it starts to look a little bit more concerning. But until that happens, JP Morgan Chase looks an interesting one for the bulls for the time being. I hope this has been useful. Not feeling 100%. It's been a big week, but it's going to be another big week for the week ahead when it comes to the earnings, when it comes to inflation. Hopefully the BLS do release it. And then the UK jobs data as well. Remember, we've also got Australian jobs. We've got inflation data coming in, trade data out of China. So a big week ahead. Thanks a lot for watching. Make sure to like, subscribe, and follow for more. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading for the week ahead.